Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Alright, in this video we are going to be discussing price action scalping. Alright, if you're new here, make sure to hit that subscribe button and give this video a thumbs up if you are ready to dive into the exciting world of price action. Alright, in this particular video, we are going to walk through everything you need to know to get started with one of the most powerful trading strategies for fast, short-term gains. That's right. We're talking about the price action scalping strategy. Now, if you've ever wanted to master scalping or improve your trading results, then this is the video for you. So let us get started. First things first, let us define what price action scalping is. In the simplest terms, price action trading means making decisions based on the actual price movement of a currency pair without relying on lagging indicators. All right. Scalping, on the other hand, refers to the practice of making quick trades with the goal of capturing small profits over short time periods. Now, when you want to combine the two, you get price action scalping, a strategy where you analyze price movements and use that information to take quick trades for small profits. This strategy is ideal for traders who want to be very active in the market, all right? Catching quick price movements and capitalizing on small fluctuations in price. So whether you are trading gold or Euro USD or GBP USD or any other pair, price action scalping can be used in almost any market condition. All right. But before we get into the details, let me break down the key benefits of using this strategy. Price action scalping is one of the most effective strategies for several reasons. All right. First, it's a direct approach, a very direct approach. You are trading based on what the market is actually doing in real time, right? What the market is actually doing in real time, rather than relying on complex indicators that can sometimes lag behind price movements. This means you are getting an edge in terms of timing. Secondly, price action trading helps you cut through the noise, right? When you use indicators, you often have too many signals coming at you, which can be overwhelming. With price action, you focus on the essentials: candlesticks, support and resistance, and trends, right? Now, this makes the strategy cleaner and simpler to follow, especially for beginners. Finally, scalping offers flexibility. You can trade during any market session, and the strategy can be applied to various currency pairs. Whether you are trading during the London, New York, or Asian session, price action scalping is a strategy you can use around the clock. Now, let us talk about the core elements of price action that you need to master for scalping. All right. The first key component is understanding candlestick patterns. We've talked about a couple of candlestick patterns in previous videos. You might want to check them out. Candlesticks are the building blocks of each of price action. All right. Each candlestick represents a period of time, right? Just one candlestick like this. For example, we are on the 15 minutes time frame. One candlestick like this represents 15 minutes. Another candlestick represents 15 minutes. If you go to a higher time frame, for example, the 1 hour, one candlestick represents price action within 1 hour. The next candlestick represents price action within 1 hour, and so on. All right. Now, the body and the wicks of each candle give us valuable information about market sentiment. For example, when you find a candle that has a long body, it shows that there was much pressure. If it is a red candle, there was much bearish pressure. If it was a blue candle, there was much bullish pressure, right? So the body tells us the gives us an insight into the momentum that was felt within that period of time. If it was on the 15-minute time frame, it shows that within these 15 minutes there was bullish momentum, there was strong bullish pressure. All right. Now, some examples of candlestick patterns include we have pin bars, we have the bullish engulfing and very bearish engulfing patterns. Now let's just talk about the bullish engulfing real quick. A bullish engulfing pattern indicates that buyers are in control. All right. For example, we can see that we had a bullish. Okay, this is not bullish engulfing. Let's see. Uh, um, all right, we had a bullish engulfing here, right? Because it swallowed up the body of the previous candle, right? So the previous sell candle. So this is a bullish engulfing pattern, and it shows that buyers were in control. All right, and because of that, there was bullish momentum, and there was chance that the buy is going to continue. So when you notice a candlestick pattern that signifies an increase in bullish momentum, you might want to enter a buy trade. All right. On the other hand, if you notice a candlestick pattern that signifies an increase in bearish momentum, you might want to enter a sell trade. Basically, that is just how it is, as easy as that, right? But make sure you get confirmations. All right, do not just jump into the trade. For example, in this situation, the price was formally coming down, right? And then we had a little bit of a consolidation around here, right? This was a consolidation period, and right after the consolidation, we had a bullish engulfing pattern that broke out of this consolidation. So we already had a confirmation because we had a bullish engulfing and a breakout at the same time, and we even had a retest around here. So make sure you get confirmations. All right, do not just rely on one candlestick pattern alone. Okay, now let's talk about support and resistance. Support and resistance are very, very important price action patterns. Okay, support is the price level where demand is strong enough to prevent the price from falling further. For example, what we have here, right? While resistance is the level resistance is the level where selling pressure is strong enough to stop the price from rising. For example, we have here. Okay, remember that support and resistance, if price is moving between support and resistance, it forms a consolidation. So we have a support here. That's the reason why price was being rejected constantly. Have a support here. We had a resistance here. Price was being rejected constantly, and a support here. Same. That is the reason why we had a consolidation. Finally, we had a breakout from this resistance. So when you are trading with price action patterns, you can decide to trade breakouts, or you can trade in the direction of the trend. For example, if you're trading in the direction of the trend, you might want to make use of trend lines, right? Because trend lines are going to help you to identify the trend, okay? Because you'll find price bouncing off the trend line. If this is a bullish trend, price will bouncing off the trend line, which would be serving as a dynamic support. So when you have price rally up and you have a pullback, you're going to enter a buy trade after the price has bounced off the trend line, because the trend line is serving as a support, right? So you can enter a buy trade after the price has bounced off the trend line, and then when you have price come back again to the trend line, look for an opportunity and enter another buy, right? And then you can make use of horizontal resistant levels to exit your trades. Okay, on the other hand, when you are in a sell trend, when you identify a sell trend, you might want to look for opportunities when the price bounces off the trend line, which is going to be serving as a dynamic resistance in that case, right? So in the case of a sell trend, the trend line is going to be serving as a dynamic resistance. So when price bounces off it, you can enter a sell, set a stop loss above the high, and you can use the support levels for your take profit. All right. Now, finally, it is very important to identify trends. Okay. Yeah, when you are trading with price action solely, remember this strategy is about price action scalping, right? So it's very important in scalping that you identify the short-term trends in the market. Okay, are the buyers or sellers in control? Is the market moving in a particular direction, right? Understanding whether you are in an uptrend, downtrend, or ranging market will help you make better trading decisions. Okay, now how do you spot a good entry point when scalping with price action? Well, the first thing you need to do is keep an eye on those candlestick patterns, all right, especially around key support and resistance levels. So around these levels, these are very important price points on your chart. So watch out for candlestick patterns. For example, we can see how we had a bearish candlestick pattern here with a body no wick below, but a long wick above that's almost the same size with the body. So this is a bearish candlestick pattern that signals a possible bearish reversal. So when you watch out for candlestick patterns around support and resistance zones, it can give you an edge, all right? Remember, imagine having a confirmation from a candlestick pattern, a sell candlestick pattern around the resistance zone. That's going to give you an extra layer of confidence to enter a sell trade, right? And then imagine finding a bullish candlestick pattern around a support zone. That's going to give you an extra layer of confidence to enter that buy trade, all right? Now, let us talk about one of the most important aspects of trading, and that is managing your risk. In scalping, since you are trading frequently with small profit targets, managing your risk is crucial to ensure long-term success. Okay, one of the best ways to protect yourself is by using stop losses, right? when you're placing a trade, always set a stop loss just below the recent swing low. That is if you are buying, right? Or just above the recent swing high if you are selling. Okay. Another risk management tip is to keep your position size small, because scalping involves high frequency. Keeping your risk per trade low is essential to avoiding big losses. Risk no more than 1 to 2% of your account balance per trade. All right. And always use a stop loss. Now that we've covered the key elements of price action scalping, let's put it all together. Okay, so here's a simple framework that you can follow to get started. The first is to identify a clear trend. All right, you may want to use the 1 minute or 5 minute or 15-minute charts. All right, and secondly, find key resistance and support levels and watch for price reactions at these levels. Now, thirdly, look for candlestick patterns that signal a reversal or continuation near these levels. All right. Then the fourth step is to place your entry when you see a solid price action signal and you set your stop loss to protect your capital. And finally, exit quickly, capturing small price movements while managing risk effectively. All right, this strategy is simple but powerful, and with practice, you can start seeing results. But mind you, this strategy does not guarantee profit. All right, like every other strategy out there, profit is not guaranteed. Okay, no strategy is foolproof. Okay, and that is a wrap up for this video on price action scalping for beginners. I hope this gives you a solid foundation to start practicing this strategy and applying it to your trades. Remember, the key to success with price action is practice and patience. So don't get discouraged if it takes some time to get comfortable with the setup. If you found this video helpful, don't forget to give it a like and subscribe to the channel. We have more tips, strategies, and tutorials coming your way. So stay tuned. Thank you for watching, and as always, happy trading.